Adam Lesner here.
Hi, Adam Lesner here today with Matthew Love. He's actually a financial architect that has some great ideas as far as what is the most efficient way to pay your mortgage.
The secret behind a 15 versus a 30-year mortgage. All right, let's dive right in. We're going to go over two examples. The first one is person A, the second one will be person B. So let's look at this. If we have a 30-year mortgage, I'm making payments for 30 years, where the interest rate that I pay for this mortgage is guaranteed never to change, and it's 100% deductible under current tax code. We're often taught to hate debt. I want to pay for my house, I want to own my house outright, so I want a 15-year mortgage instead of a 30-year. Let's look at what happens. I owe $1,000 a month, but if I get a 15-year mortgage, I have to pay more. Now I'm going to spend $2,000 a month. My loan rate now gets down to zero after 15 years. Person A owns his house after 15 years. What can he do with the $2,000 now? Anything he wants. Let's say they start saving. And they get to a point. After the 30 years, they'll actually have savings. They'll own their house, and they'll have another account they can use. I want to show you a secret. If I have the ability to spend an extra $1,000 on a mortgage, what if I didn't pay the bank and I paid myself instead? Now, my $1,000 can go into an account that I can control, and it starts to grow. At some point in my savings account, I'll have enough money that I can stroke a check and be debt-free. But here's the true question. Is it better to own my house outright, or have enough money in an account somewhere else, completely uncorrelated with the real estate market, where I can stroke a check and be debt-free if I want to? Meanwhile, I get to take advantage of the deductions of all the interest rate that I owe. See, in 15 years, what's the housing market going to look like? Where are taxes going to be? What is my income level? When will I know if I want to own my house in 15 years? In 15 years. See, as person B, I get to make a choice. If I want to own my house, I can. If I don't want to own my house, I still have just as much value in an account completely separate. And if I choose to, I can stroke a check and be debt-free. If I have another account that I'm taking control over today, in 15 years, that's cash that I can use. Then in 15 years, I get to make a choice. Do I want to own my house, or do I want to enjoy my cash? If I want to minimize my risk in the real estate market, maybe I can invest somewhere else. The principle is called arbitrage. I'm playing two different markets against each other. The bank owns my house, and I get to deduct the interest, an honest-to-goodness deduction. I'll never pay tax on that interest ever again. And I have an account over here that can continue to grow. See, what happens if I'm person A, and I'm spending all of my money where I want to own this house outright, and 7 years into that plan, I lose my job. I get disabled. I get in a really bad car accident, and I can't even work anymore. So let's think about this. There's a few principles that we need to take away. Right now, our interest rate's high or low? They're low. They're some of the lowest interest rates we've seen in years. I can lock in an interest rate for 30 years that's guaranteed never to change, where the interest that I spend on this loan is deductible, 100% deductible for the average person. Every month that I spend money on a 30-year mortgage instead of a 15, I get to take home more money to my family. I have more cash in an account that I can spend in case of an emergency. I have more flexibility. The question comes down to this: if I could be person B, would I want to?
Matt, really appreciate that feedback. I hope it helps you understand as a 15-year mortgage really what you thought it was as far as making sense for your particular situation. So thanks again for coming out, Matt.
My pleasure.
Thanks for having me here, and hope to see you again soon. Appreciate it, man.
Appreciate it.